Hello everybody, welcome back to the channel. I have an amazing video for you guys today. Here is an article from the Washington Post. You could find this article down in the description below. I will have a link to it. Now check this out. The Fed's damage to the housing market may last years. Now, as we know, because of coronavirus, the housing, the Feds really had to do something to correct the economy, right? When everything shut down, everybody was scared. The government is literally telling us to stay home. A lot of people got on unemployment. Everything was crazy. We don't really need to relive that time. But basically, some believe that the Feds made some big mistakes, right? And those mistakes might have long-lasting effects in our economy. Here, let's read a little bit and to understand what this article is really trying to say. With interest rates now hovering around 5%, existing home sales are down more than 14% from last year. Some potential buyers are sitting on the sidelines until rates or prices or both decline, which sellers are hoping the market picks up again so they can get a higher price. So that's what, a lot of buyers, that's definitely what I've been recommending to people, that basically if you're looking to buy, it's probably a good time to wait, right? Because we don't really know what's happening. Now, I don't necessarily think the rates are going to drop much lower than what they are now, because inflation still remains, a big elephant in the room. And, as far as prices, I do believe the prices are going to come down. Now, I've always believed that it's better to buy a house with a lower price with a higher interest rate than a higher price with a lower interest rate, because if you buy the house lower, your property taxes will be a lot lower, and you could always refinance. You just have to wait a few years and eventually the rates do come down. Okay, let's keep reading. But don't count on rates falling to those pandemic lows. They were a result of extraordinary market manipulation from the Feds, and unless this becomes regular feature of monetary policy, rates are not going to go back to what they used to be. The real estate market has been on a wild ride. House prices measured by the index increased 30% between March 2020 and December 2021, a steeper rise than the lead up to the end of the housing bubble in 2008. This was part because many people moved during the pandemic, but also because 30-year mortgage rate was only at 2.65 in the spring of 2021. This basically caused a frenzy, and what happened was that because we had low supply, it made the prices shoot up. So there was a lot of things happening, guys, that just made the bubble be where it is right now. Okay, let's keep reading. The impact of the Fed's interference may be felt for years. In the spring of 2020, the Fed was desperate to avoid economic collapse, so it reverted to its 2008 playbook. It cut rates to zero and brought back quantitative easing, buying long-dated government bonds and mortgage-backed securities. Most residential mortgages are securitized by Fannie Mae or Freddie Mac and resold in what is known as mortgage-backed securities. In 2020, mortgage-backed securities market was in trouble, and Fed was even more aggressive than it was in 2008. It effectively became the only ultimate buyer of those securities. It is holding an agency MBS increase of $1.3 trillion between 2020 and 2022. That's insane, guys. While the market for agency mortgage-backed securities grew $1.5 trillion, the Federal Reserve now holds more than 40% of the total outstanding amount of agency MBS, or nearly half of the market. This is insane that the government could own so many of these bonds. But now let's read a little bit more. These actions were one of the big reasons rates fell so low. Your mortgage rate is based on a 10-year bond rate, plus the premium for extra risk involved. The size of the risk premium is largely determined by the MBS market, based on the liquidity and risk of the investor takes on. The figure below show the Bloomberg US MBS index minus the yield on the 10-year bond. The spread spiked at the beginning of the pandemic, but then as the Feds kept buying, it fell to nearly zero and the housing market raged. The spread started rising again in June once the end of the quantitative easing was in sight, and then it rose further when the Fed started to taper its purchase in the fall of 2021 before stopping in early 2022. The spread is now higher than it was before the pandemic. Buying mortgage-backed securities may have made sense in the spring of 2020, but why the Fed did not start tapering for 18 months, even when the housing market was clearly overheating, was never explained. Whether quantitative easing actually helps the economy remain a divisive topic among economists. Fed economists insist that it does help, while academic economists are more skeptical. But there is evidence that when the Fed buys mortgage-backed securities, it brings down the MBS spread and mortgage rates. So that's basically what it was. They wanted to bring down the rates because they wanted to get money into people's hands so we could get through that dark period when coronavirus basically shut everything down. And to finish up this article, the Fed has come under a lot of criticism lately for being too late to raise rates in response to inflation. But another policy error could have been that it kept buying so many mortgage-backed securities later in 2020 and most of 2021 when the housing market was on fire and rates kept dropping. So what do you guys think? I mean, Here, let's finish out the article. A 2.6 fixed rate on a 30-year risky asset never made much sense. It suggested that something is off in the market, either through some manipulation or mispricing of risk. The Fed created major distortion in the market where many Americans have most of their wealth, and it may impact may be felt for decades. So what do you guys think? Do you think the Feds did the wrong thing by, lowering the rates to zero, buying all these mortgage-backed securities? Remember, we were in a tough place, especially when coronavirus shut down everything. And I think the government was really scared. But when you go ahead and, basically flood the market with so much free money, essentially, we basically have inflation. Now we're trying to fight inflation. Now we're trying to shrink the economy to suck those dollars out of the economy, which is going to have a huge effect on not just the housing market, but our daily lives. We're seeing right now how everything is more expensive. When you go to the market, everything is more expensive. When we're spending more to live, then we are not able to save as much, especially for a down payment. If you own a house, it makes it harder for you to do upgrades to the house because contractors are charging an arm and a leg these days because everything is expensive. Basically, all the materials are expensive, the work is expensive. So energy is expensive. So as a whole, it's definitely, I'm seeing a slowdown in the economy. We're gonna have to see the next GDP report. I predict that, most people are just buying the essentials, and they're gonna have less money, so there's gonna be less consumer spending. And it really does scare me going into the holiday season, because remember, a lot of companies make most of their money during the holiday season, and if they start showing lower sales, that could have a huge impact on the housing market come the beginning of next year, when if companies sort of start reporting more layoffs, we could definitely see some problems. So I definitely think that for the housing market, if you are thinking of buying, I would say we're gonna have some really good buying opportunities come January, February, because in my prediction, we are going to see those prices start to slide quite drastically, in my opinion. Now, I'm gonna go ahead and finish this video. I just wanna say a big thank you to everybody who has been supporting my channel and watching my videos, liking my videos, and commenting on my videos. It really does mean a lot to me, and I just wanna say thank you. And for those of you who are new to this channel and you like my videos, don't forget to smash that subscribe button and go ahead and like and leave a comment. Again, thank you guys so much for watching. I love you guys, and I'll see you on the next video.